Hello everybody, it's Tortoise Investing coming at you today with 5 more dividend stocks that you can buy and hold forever. Yins love them. I love to make them. I like doing the research and things, trying to find some sells still out there for yins. As always, do your own research before investing into anything. None of this is financial advice. And I just want to say welcome to the new subscribers. We're at 525 and counting. Last video got over 1K subs, and I know I got, not 1K subs, 1K views, and we got a bunch of subs off that, which is awesome. So yeah, let's keep marching on to 1,000 subs. I appreciate everyone's support, comments, likes, every bit of that helps. It makes the YouTube algorithm super happy, and like that is a whole thing to figure out in itself, but we're doing it. Let's keep growing the channel and our portfolios together. But without further ado, today we're going to take a look at Lockheed Martin, Texas Instruments, Canadian Pacific Railroad, BristolMyers, Squibb, and Altria Group. Now, Lockheed Martin has adjusted free cash flow yield of 5.11%, dividend yield 2.69%, and a payout ratio of 43%. So very nice. Take a look at the revenue over the last 5 years. Been increased at a rate of 5.27%. A little bit up and to the right going on right there. And if we take a look at the free cash flow over the last 10 years been increased at a rate of 25.77%. That is awesome. They have been getting government contracts left and right for the military, and I read up that they are like working on some like laser technology when it comes to their military weapons and stuff, which is that's pretty neat. EPS been growing at a rate of 24.56% over the last 5 years, right at 9% plus over the last 10 years. Again, up and to the right, growing EPS is great and a growing free cash flow. You like to see it. It has been declining slowly since 2020. This company has a moat and a half. I love Lockheed Martin. I don't know why I say it like that. Anyways, dividends been increased at a rate of 10% over the last 10 years. They do have some debt at $15 billion. Their EBITDA is $4.7 billion. So no issue there whatsoever. I don't like companies that have more than 3 times their EBITDA in debt. This falls right in line with what you like to see. Again, this is just my personal opinions. Over the last 10 years, I've been buying back shares at a rate of 1.67%, so not too bad. It has been kind of expensive as of late, so let that free cash flow grow, and if you dip any, go ahead and buy back those shares, Mr. Company. Return on capital employed is very reliably above 20%. From 2018 to now, it's just hovering between 22 and 24%, so that is very nice. Lockheed Martin is off of a recent high of, I think it's like 500 and something, a little bit over $500. So it's down about $60 off its recent highs. So I like that. You know, it's on sale in my eyes, and it looks like the market's just open. Let's take a look at these now. Texas Instrument has adjusted free cash flow yield of 1.85%, has dividend yield of 2.94%, and a payout ratio of 54%. Take a look at the revenue. Revenue has been increased at a rate of 6% over the last 5 years. They have been accelerating as of late, 17.68% and 9.18%. So very nice. I know they're trying to get into the AI tech as well. Free cash flow has been increased at a rate of 7.33% over the last 10 years. EPS has been growing at a rate of 20%. This EPS growth is just bonkers to me. This is awesome. Let's see here. The debt, they have some debt at $7.8 billion. Their EBITDA is $11 billion. There's no issues there whatsoever. They have more cash than debt on hand. Like, that is something you don't see very often. And this company does it pretty reliably. Dividend's been increased at a rate of 16% over the last 10 years, even though it looks like it has been slowly slowing down. Last 5 years of 14.8%, and 10 years the last 2 years. So still a nice compounding effect there. Let's take a look. Share buybacks over the last 10 years at a rate of 2%. So that's very nice. Since 2005, it looks like I've been just shopping at that share count. And the return on capital employed has been growing since 2020. That was at 34%, and it is just 41.8. So that's very nice. This is a really great return on capital employed. I like anything in like the mid-teens, low 20s is like considered really good to me. And this is just bonkers. Like this is such a strong company. The reason for the recent dip here, as you look, it was over 185 plus. They reported a negative cash flow quarter for the first time in like forever and a day, if I remember correctly. Yeah, last time that happened was, what was it here? 2004, I believe. Yeah. The reason being is they have dumped so much money into AI, and that's good. That's like the thing right now. You want your company to do that. So yeah, Texas Instrument, that's one I've got my eye on to see if it dips any lower, but still a great, great little company right there. Now, next up, we've got Canadian Pacific Railroad. Don't know what's going on with that free adjusted cash flow. Yeah, let's take a look here. Let's see here. Yeah, I don't know what's going on with that. Anyways, quarterly? No? I don't know what's going on with that. Anyways, free adjusted cash flow yield 3.46%. We're going to go for that one. Dividend yield of 0.71%. Payout ratio of 25%. Take a look at the revenue. Revenue's been growing at a rate of 6.1% over the last 5 years. Very nice. Take a look at that free cash flow. Free cash flow has been increasing at a rate of 30% over the last 10 years, 25% over the last 5 years. This is just, it is taking off like a rocket. And this is one of the better railroad companies. This one and Union Pacific are like the two that I love the most. And I think they're great. Canadian, I think it's CNI, Canadian National or something like that. That's another pretty good one. Let's take a look at EPS. EPS has been growing at a rate of 21% over the last 10 years. Very nice. Looks like as of late, though, it's kind of stalled out a little bit. I know because of COVID, a lot of these took a big hit. Pretty much everything's still recovering from that. That was 3 years ago. Railroads usually carry quite a bit of debt. This one's at $17.8 billion. EBIT is at $5.65 billion, but you're going to see that with pretty much every railroad company. They use a lot of debt to buy back shares, and it's okay. Let's take a look at the dividend. Dividend's been increasing at a rate of 7.99% over the last 10 years. Very nice. It's kind of like a little bit of all over the place, but still, it's a strong little compounder. Now, take a look here at the share count. The share count was decreasing. They had this bump because they did do an acquisition here as of the last little bit. I forget the name of the railroad, but Kansas City Pacific. I think this is it. Kansas City Limited. Yeah, they it's good when you're a company that you like acquires other companies, because it just increases the revenue stream and that makes things stronger. They did it with shares, with their own shares, so they didn't have to take on additional debt, which it's okay. They keep buying back shares and stuff. It's not a problem in my eyes. They were recently at $84. They are down to $80.94 as of right now. This is all live. Market's open right now. But yeah, this has been a strong market beater over the last 10 years. This one I've been keeping my eyes on as well, because I want to get something that's in the industrial space, and I feel like railroads would be the way to go with that. But yeah, Canadian Pacific Railroad, pretty good in my eyes. All right, next up, we got BristolMyers Squibb. BristolMyers Squibb has a free adjusted cash flow yield of 8.08%, dividend yield of 3.77%, and a payout ratio of 65.6%. A little on the high side, but that is okay. It was a free cash flow yield. It's a little wonky there. It's not loading. Load! Anyways, revenue has been increasing at a rate of 10.11% over the last 10 years. And 17% over the last 5 years. They had a big boom. They got some new medicines that they've been working on. I think there's a new cancer medicine and some other treatments that they got in the pipeline. So that's just going to be more free cash flow for them. I don't know why that's not working. Anyways, take a look at the EPS. EPS has been increased at a rate of 9.78% over the last 10 years. And let's take a look at the dividend. The dividend has been increased at a rate of 5% over the last 10 years. Not too quickly, but you're getting 3.77% dividend yield, so you're getting a nice little dividend yield there. Debt's $34.9 billion. Their EBITDA is $19.9 billion, so again, that falls in the parameters of the not having 3 times more EBITDA than debt. And since 2020, again, pretty much everything got hit real hard then. The return on capital employed is slowly going back up. Now, this company is beat up a little bit this year. I apologize for free cash flow. You don't know what's going on with that. Down 16.29%. So if you're looking for a healthcare stock, a lot of there's still some healthcare stocks out there that have been beat up pretty bad this year because everything is just like check AI money. But yeah, BristolMyers Squibb, maybe something you want to look into. And lastly, we got Altria Group, the tobacco goat. It's got a free adjusted cash flow yield of 10.88%. Dividend yield of 8.55%. Payout ratio, I would not pay that any attention. Free cash flow is what you should look at when it comes to paying the dividend down. And I think this one's hovering around 70, 75%, maybe 80 now. But it is definitely not 120%. Revenue's been increasing slowly but surely. But this thing's been around forever, so it's not going to have rapid growth. They make a lot of their free cash flow and stuff through price increases because cigarettes is like one of the most addicting things in the world. And some people would just cut off a finger for them. And I personally don't do it, but, a lot of people still smoke. And they've been increasing their free cash flow yield at a rate of 11.26% over the last 5 years. And the EPS has been increasing at a rate of 4.57% over the last 10 years. They did have the little spinoff. You're seeing these little like weird dips here. That's when they spun off Philip Morris, I believe. And so that's the reason you're going to see a little bit of those little dips in there. They have been increasing their dividend at a rate of 7.8% over the last 10 years. And they've been reliably doing it about 4 to 5%. And I think they said that's their main goal going forward. You're going to 8.55% dividend yield. And it's going to be increasing at a rate of 4 to 5%. Not too shabby, especially if you're looking for like a little bit more of an income play, wanting to get a little bit more dividend just in your portfolio as a whole. Might be something to look into. Old Altria there. Their return on capital employed is it's ridiculous. 20s, 30s, that's pretty much where they hover. Because again, they have pricing power. They can charge whatever they want, and they have been doing that, and it's been increasing like crazy, but they're still doing pretty well, even though I think I read a thing like 22% less smokers of like cigarettes and stuff now than a couple years ago. So it is something that's going down, but they bought Enjoy. They just acquired that, and I know vaping is like the new powerful craze that everyone's doing, and Altria is trying very hard to get in that space. I think they're going to do it. They're doing way too much to not. And I like it. They're down from their recent highs to, let's see here. They were around in the 60s there at one point, and mid 50s last year. So $43.98 might be a good little entry point. Again, all of these are just things I think that are on sale. Might be good little things to do a little bit of research into. Always do your own research and stuff before investing into anything. But yeah, it's everything I got for you. Hope you enjoy that, and until next time, see yous.